Ask Annex is where we open up the mailbag and we get to people's questions. Get a lot of them. You head to our website, annexwealth.com. Look for the Ask tab. If you want to be anonymous, that's fine. In fact, everybody today is anonymous. Matt Morzy, investment team manager and a CFP, joins us in the studio. Welcome.
Hey, Danny.
And we got Trevor Nargis, senior trader at Annex Wealth Management. Welcome back.
Hey, Danny.
First question, were there indications that Nvidia was going to have a huge quarter? If so, what? If not, why not? Can you set the stage on Nvidia?
Yeah, we can try and take a swing at that. So Nvidia has had some really good quarters as of late. So maybe that's been somewhat of the indication that they were going to have a good quarter. But as far as are they going to really blow estimates out of the water, things like that, they tend to reserve that information for earnings calls, for investor events. You know, you'll see companies sometimes come out ahead of earnings and say, hey, things might not be so good, to kind of help brace markets. But if they're going to beat, you tend to see things stay kind of quiet. So wasn't necessarily an indication ahead of time that things were going to be crazy. But for the recent quarter, company beat on both earnings per share and revenue. But what really drove the hype around the stock was the guidance that came from that call. So the forward-looking guidance. So our teammates, Jason Cooper and Brian Jacobson, talked about it on our SWAT podcast the other day of what that forward guidance kind of implied. And so they increased revenue guidance from $8 billion to $11 billion for this quarter. So what that did is that drove analyst estimates higher, as well as expectations for the future growth of earnings. So the company sees growing demand for things like their data center products because those tend to help the processing power needed to support AI. But companies like Nvidia tend to be valued on growth. So that guidance going much higher makes Nvidia look a lot cheaper. Hence the reason you saw kind of the bump that you saw in the stock.
Yeah, you usually don't get that big of a bounce, because it's going to be a surprise, or people are not expecting that much of an increase. And as you said, the last few quarters, they've really been hitting the gas in terms of, how they've been talking about the company and what the future of Nvidia looks like, and how they're really, in their minds, going to be the center of all this new technology that's going to be coming out. So did everyone expect great things from Nvidia? Yes. But obviously, the expectations were not high enough for what they think is actually coming today versus just that future world of what, they were kind of trying to lay that groundwork.
And that goes back to what our Chief Investment Officer, Derek Felsky, was saying alongside Jason the other day when they were updating the model on Nvidia, that they updated the numbers and they just kind of went, whoa, because those estimates just went so much higher. And when the company is a growth-like company and it's valued on growth, when that growth keeps going, it makes the company look cheaper.
They really own the week, didn't they?
Oh, for sure. And they, crossing $1 trillion, dollars from a market cap. We talked to, like you said, on the SWAT podcast that came up this last week, but also I know the Difference podcast as well, too. That was a big topic of conversation.
Next up on Ask Annex, Memorial Day weekend barbecue argument. Shouldn't a 35-year-old investor be more concerned about growth rather than dividends? Isn't that a dad question, right? Just read like a dad question.
Well, I spent the weekend with some friends. We're about 40 here, and that was a lot of the conversations about the markets and investing. So I certainly understand those holiday type conversations. When I think about where you're getting the returns from your portfolio, what I think is really important is just that overall total return, which could either come from price appreciation, which is probably what they're referring to the growth side of this as, or from income or dividends. And really what I'm looking at is I really don't care where that's coming from. I want the return, the total return. Now, if you're younger, you could take more risk, which means that you could afford to have less income today and shoot for more price appreciation and either make your own dividends if you need cash. What I mean by making your own dividends is by selling shares to create cash instead of having the company send it out to you. But you're also, if you're younger, you could take the risk of that company maybe not having that growth potential sooner than later and having the stock price fall down. Because you're really, when you're not getting that income, you're relying on somebody paying more for that stock than what you paid for it. You're not getting that cash flow from the company at all.
Yeah, I think the last thing I'll add is that there's not necessarily a right answer. It comes back to something that Matt, you and I have talked about, and we've talked about with another Ask Annex regular, Sarah Kyle. It comes back to risk tolerance versus risk capacity. So risk tolerance being how comfortable do you feel with the potential ups and downs of your investments? So maybe growth-related stocks, you might have more ups and downs along the way. Dividend payers maybe tend to be a little less volatile. But then there's risk capacity, right? What can you financially actually handle? What is your ability to handle potential losses associated with risky investments? So I think it's really balancing the two of those alongside what Matt was getting at.
It's also important to remember, you could have both. Like if you look at companies like Apple and Microsoft, they're the two largest market cap companies. Their growth has been tremendous, and they also pay dividends that they're growing above market growth rates as well too. So you are able to have both of those. And again, if you're thinking long term with that, you can also reinvest dividends yourself back into that stock and just buy more shares and keep having that compound over time.
Did you guys really talk about investments during your Memorial Day cookout?
That was quite a bit of it. Yeah, one of my friends and I, we talk quite a bit about the markets and what's going on. So I'm sure our wives probably got tired of it.
Totally bored. Yeah, very nice. Matt Morzy, Investment Team Manager and a CFP at Annex Wealth Management. Thank you.
Thank you.
Trevor Nargis, Senior Trader at Annex Wealth Management. Thank you.
Thanks, Danny.